Hello, my name is Evan, and welcome to Evanomics 101, your number one source for everything economics. Today I want to make a quick video to talk about the current housing market, some of the challenges that we're currently facing, and some of the challenges that we've faced in the past, and kind of currently where we are with our housing market, inventory, prices, etc. I want to kind of break down a little bit about that in this video, but before I do, please like, share, and subscribe. So before we get into it, just a recap on kind of currently where we are with our supply levels or inventories as far as our housing market is concerned, and as it relates to 2025, March 2025. So currently we're about 3.5 months, well, a little over 3.5 months of for sale supply that is on the market. That is the most supply or the most inventory that we've had in the last 5 years. Back in 2025, we had less than a month of for sale supply or inventory available on the market. So we can see that supply has increased over the course of the last 5 years. However, we are still not in what's considered a balanced housing market. In order to be a balanced housing market, you need 6 months of for sale supply or inventory that needs to be on the market. So we got a little bit of ways to go. However, we have made strides, we have made improvements in the last 5 years. Currently, as far as prices go, in 2020, basically 5 years ago, we were looking at the average home price between $280,000 to $300,000, and as it is now in 2025, the median home price is $450,000. Near there, I'm kind of rounding off a little bit, but you kind of get the point that there's been a significant jump in home prices over the course of only 5 years. But what a lot of people don't realize or fail to acknowledge is, although home prices have gone up, the cost of owning a home as well as the cost to borrow have also gone up. So what I mean by that, the cost of owning a home, you have seen tremendous increase in your insurance costs as well as your property taxes over the course of the last couple of years. And those costs are going to continue to go up, mainly due to inflation. Also, the cost to borrow money has increased. Before, when you had low interest rates, a lot of people could purchase homes, which would equal a low or affordable mortgage payment. That's not necessarily the case now. When you were back in 2020 and before 2020, before pandemic, your interest rate, you might have an interest rate of around 3%, 3.5%. Now that's just not the case. You're looking at an interest rate of possibly upwards of over 5.5 to maybe even 6, maybe even 7%. So a lot of things have changed over the course of just 5 years. We are faced with an affordability problem. We have high demand, we have increased supply. However, prices and the cost of home ownership have increased significantly, making it almost unaffordable for a lot of people to buy homes. So what should we do in that type of situation? I think it's a question that you have to compare what should we do versus what we need to do. I'm going to reflect and go back to interest rates, because interest rates, they play such a big part in where we are in our economy right now. So what should we do? If we lowered rates, that would make things a lot more affordable for people. It would also allow builders to be able to build more. However, if we lower rates right now, we're going to just add to our inflation problem. So on the flip side of that, what do we need to do? Well, we need to be raising interest rates. However, if we were to raise interest rates, we would probably go into an economic recession immediately. Higher rates basically makes housing already more unaffordable. It's already unaffordable, but if we raise rates, that makes it more unaffordable. That means less people are going to be buying properties, as well as it makes it harder for builders to continue to build to increase supply. But again, if we were to raise rates, automatic overnight recession more than likely. However, I think we just prolong rates by doing what the Fed did last week, by keeping rates unchanged or even considering lowering rates. What's going to happen is, in my opinion, eventually rates will have to go down. Rates will have to go down because we're going to be facing an economic crisis, a financial crisis, a debt crisis that I know under the new administration, they're not going to want to take the responsibility for that. So any new president coming in, any new administration coming in, they want to show economic growth. And especially under this administration, we're going to be lowering rates, which means inflation is going to continue to increase, and that's only going to hurt individuals like myself, as well as the majority of people in the United States. So that's just my opinion. I'm not a financial advisor. I'm not telling you what you should do with your money or anything like that, but I am telling you what is coming. Prices are not coming down. Prices are just going to continue as it relates to homes. In some areas, you may see some prices come down, but overall, prices of homes will increase. The cost to own a home will increase. The cost of borrowing money eventually has to increase. We have to increase the cost to borrow money, so to deter people from borrowing money and increase saving money. But stay tuned for more videos as I'm going to talk a lot more about the housing market, interest rates, inflation, all of that. On a weekly basis, I'm going to continue to discuss and go over some of the things that are happening in the market so that you can be better prepared in whatever you decide to do in your current financial position. So thank you for tuning in. Please like, share, and subscribe, and stay tuned.